I have identified these companies as companies that have a really good product or service, that
Mm-hmm.
have good management, that have a good market for this product or service, well-paying customers, and a good moat, a good way of being able to protect your business, right? So if there is
Okay.
all of this, okay, and I know that this company is going to grow, 5x, 10x over a period of time, over a decade, right? Then I should just allow them to take my money, invest it in
Mm-hmm.
that business, and sit back and um, like Marcellus, the authors of the book, they say, it's on their website that investing should be like sitting down and watching the grass grow.
Good morning, good afternoon, and good evening to our listeners on the Book Talkies. And today we are going to talk about Coffee Can Investing, the low risk road to stupendous wealth. It is written by three gentlemen, Pranab Uniyal, Rakshit Ranjan, and Saurabh Mukherjea. And the book was introduced to me today by one of my Accenture colleagues. Let me introduce and let me welcome Deepak Pai. Deepak, welcome to the Book Talkies.
Kaustav, it's my pleasure to be on the Book Talkies, and I would love to talk about this subject.
Just introduce yourself to the listeners and let them get to know you.
Okay, so just a little bit about myself. I've been with Accenture for the last 17 odd years now, predominantly in the technology business, working mostly with life sciences clients. All through the journey, ever since I was a kid and I was growing up through college, I have been into some sort of reading. I think reading always came very naturally to me. The quest for knowledge, the quest for understanding different points of view, really getting a lot of value out of this, right? That has always been, very, very big on me. At some point in time, I started moving away from fiction to non-fiction, and especially into finance. I would say probably maybe 10 years into my career, right?
Okay.
Because that is where I felt that, me as a person, my whole approach to investing, my whole approach to, making ourselves financially independent, so that you don't really have to rely on somebody else. Of course, all of us mostly started with humble backgrounds, and we did not really have the kind of capital to be able to invest at that point in time. But
Right.
but the fact that we started off at that point in time, really understanding various different facets, etc., that really drew me and attracted me more towards finance as a subject. And that's where I started reading a lot of books. I started hearing a lot of podcasts and other personalities and so on and so forth. And I've been dabbling in quite a few things of my own. Coffee Can Investing was one of the books that I really liked, because the simplicity of how it was presented, and the clarity of thought, the ideas. I think the authors have a fantastic view of the subject, and I really liked it. It was a very easy read. I finished it in less than a weekend, and it was fantastic. It's a good 300 pages, but it's a very easy read. You can really read it very quickly.
Wow. I hadn't heard about this book at all before you proposed this. And I imagine myself that I am walking into a Crosswords bookstore.
Yeah.
And I am in the finance and wealth management section. I'm looking at the books. And if I see Coffee Can Investing as a book name, it's like those websites, like we said, the top 10 things to top 10 things to explore. Number 3 will blow your mind. These are clickbaits.
Yes.
Right? So for me, the term, so Coffee Can became a clickbait, I don't know. So I would really be very interested to know about Coffee Can Investing. What is it? Yeah.
Coffee Can Investing comes from the pre-bank era, right, where people used to save money in coffee cans, right?
Mm-hmm.
And they used to just put money in those coffee cans, and forget, that you have, that money, in there, and discover that money after a period of time, and get the joy out of that, right? The philosophy is that you create a portfolio of stocks, okay? And
Okay.
I'll come to what kind of portfolio of stocks and all that, but just imagine you create a portfolio of good companies, you identify those companies, and you invest in those companies, and you forget about them. You completely
Okay.
forget about them for a decade, okay? And then after a decade, you come back to see what kind of returns, that portfolio has given you. You will be surprised that the portfolio has given you returns that can beat the rate of inflation, as well as beat the returns from a, let's say, a fixed deposit, or a gold purchase, or even real estate, right? That's the beauty of this.
Wow. I mean, like, it's like do and forget.
Do and forget, absolutely, do and forget. And
Wow.
I think it goes on to say that, I mean, one thing I have to tell our listeners is that I think trading is overrated, right? Especially when you're talking about, short-term investing, or investing for, a day, 2 days, or even taking on positional trades, etc.
Mm-hmm.
That I think is overrated, because only 10 to 15% of the people, the traders, actually make meaningful money out of that, right? And majority of the investors either don't make money at all, so they are at net neutral, or they end up in losses, right?
Mm-hmm.
So it is a form of investing that I don't really recommend. Of course, there are new methods like quantitative methods, etc., that are coming in at this point in time, and I think it is best left to the experts to really do that. But as individual retail investors, if there is one way, which kind of gives you a really good path to, good amount of investing with a good amount of returns over and above the inflation, I think that is coffee can investing. And this book really does a lot in terms of clearing your fundamentals on coffee can investing and how you can.
Okay. And you also mentioned that it was a very simple read for you. You do not need to be a finance expert to understand this.
Not at all. Absolutely not. Yeah.
Okay.
Anybody, even with no background in finance, can actually read this book, okay? Because it all deals with personal finance, stuff that is relevant to you, okay? Decisions that you've made, you've purchased gold, you've purchased real estate, you've made fixed deposits, right? And all of us would have done that, because we would have seen our parents do that. That's how we grew up, right? And we would have initially started with that, right? Equity came in, much later, and equity was always considered a very high risk sort of investment because of the some historical reasons. I mean, some scams that we've had in the market, and a lot of speculation going on, and so on and so forth. But this book sort of clarifies that, if you get some fundamentals clear, if you look for this portfolio of companies, and they've articulated how to look for these companies, right? And if you do that, then there is a very good chance that you will be able to make a decent return from a portfolio.
I'm assuming that in the book, Saurabh, Pranab, and actually the writers, they do suggest, or they do give certain tips of how to pick the right stocks to invest in. Do they do that?
They absolutely do, yes. So they have a methodology for how to really go about it. And I mean, at a fundamental level, what it really looks at is companies that have high growth in revenues. So your revenue is good. So year on year, your revenues are growing.
Yeah.
Very good ROC, which means return on capital employed. So which means that when the company raises money, either from investors or it raises money through debts from the bank, how is that capital really deployed, and the company's ability to generate returns on the capital employed, right? Good management, of course, right? A strong moat, for example, for the company, right? So these are some of the things that really determine what sort of companies you should really have in that portfolio, and you start applying filters to the entire universe of companies, and then you are left with a very small handful of companies every year, right? So they have tried doing this every year, and they have said, okay, for this year, these are the top 10 companies as per our methodology, and then they've tracked, they have done sort of a regression testing on this, back testing, right? And they have figured out, what return would that portfolio have given every decade, right? And it's amazing to see that most of the time this portfolio would beat the inflation for that decade, and it would beat the real estate returns or the gold returns for that decade. It's amazing.
Wow. Okay. So out like a full package. I mean, I like this. I was looking for something like this, and I'll tell you the reason behind it. I am a very, very risk-averse investor. I think my second day of the job was when Lehman Brothers declared bankruptcy.
Yes.
I just knew the term recession. Didn't know what is happening, but you could sense the negativity or the fearfulness that around, right? And you always see those. We have these in India. We have this our PAC and NSE, and from movies, right? When the graph is going down, like it's fear. People take drastic decisions with their lives. They lose their livelihood, etc. You have all that in their mind. For me, no, I am not going to enter here. I am not going to put a single penny in this equity market. Frankly, I didn't even understand data or equity, but stock market I don't want to put any money. Luckily, I'm married to a very smart woman, so she's the one who takes all the risks. I'm a very safe player. I invested in real estate, bought myself a house. I still have FDs as my emergency fund, because FDs, it's not going anywhere. Whatever government is doing, Pradhan Mantri this Yojana, that Yojana, I will put money there because it's government. Play safe. And I remember a very good statement in that book, by Psychology of Money. He says, your plan is a good plan if you plan your plan not going according to your plan.
Yeah.
Yeah,
you got it right.
I mean, it's a mouthful, but Murphy's law. It's going to go down, so plan for that.
No, absolutely. See, ups and downs are part of life, right? And I mean, Newton's third law of motion says it, right? A lot of our Shastras and Vedas talk about it, especially if you go into any one of these spiritual courses, etc. They will also talk about mindfulness and the need to really balance out and so on and so on. So, I mean, of course, there will be bear cycles and there will be bull cycles in the market as well. They are also natural phenomena, right?
Yeah.
Now, if we try and time the market on some of these things, right, that's a very difficult thing to do. Okay, and even the experts are not very good at being able to time the market. Of course, some people will claim that they are able to time the market and they are able to make money, but sometimes I don't know if there is, even after reading so much, it's very difficult for me to say that you are really aware of exactly when the recession is going to happen, right? There's a very, very good movie and a book on the 2008 recession. It's called
The Big Short.
The Big Short. It's fantastic in the sense that it tells you about people that were able to predict this bubble in the housing market. But even when they predicted the bubble, it took much longer than that, for that realization to happen, right? And so they had to hold for a very long time against a lot of popular opinion at that point in time, right? So it's very difficult in my view to really be able to time the market, and so therefore you've got to look at the market as a flowing stream and say that, okay, I am going to I'm going to keep investing in smaller quantities at regular intervals so that I can balance the impact of it over a period of time, right? So I will not wait until there is a bottom formation, because I really don't know when the bottom formation is really. So maybe every month or maybe twice a month, I can invest smaller quantities of money into it. And over a period of time, I'm assuming that these companies will really do well, because I have identified these companies as companies that have a really good product or service, that have good management, that have a good market for this product or service, well-paying customers, and a good moat, a good way of being able to protect your business, right? So if there is all of this, and I know that this company is going to grow, 5x, 10x over a period of time, over a decade, right? Then, I should just allow them to, take my money, invest it in business, and sit back and, like Marcellus, the authors of the book, they say, it's on their website that, investing should be like sitting down and watching the grass grow, right? That is how investing. So, and that's what your job is, to be able to identify the right kind of companies and just invest in them and sit back, right? A little bit similar to management is what I would say. Your job as in management is really to be able to give the right kind of resources to your team. Give them direction, give them clarity of thought, remove any constraints, and then get out of the way. If you try to micromanage at that point in time, it's going to go, all the way over. So it's a very good and interesting philosophy, and one that I completely believe in.
That's great. I would really like to know. So assume you had like X portfolio before you read this book.
Yeah.
You read this book, and now has your portfolio enhanced some way or the other using the principles, the methodologies that the writers mentioned in Coffee Can Investing? Has it helped you that way?
Oh, absolutely. And what that book made me do is, made me do a lot more research into the companies that I buy, and also other books by Saurabh and team as well. I've read The Unusual Billionaires and couple of others. The Victory Project, I think I've read that as well. And then I have looked at Saurabh's interviews and the way he thinks about investing and so on and so forth, and the problem with investing in India particularly, right? Because 85% of the companies are not going to be there for more than 2 decades, let's say, because they come, they list, but they fall out of favor and they are not able to continue, right? So then you've got to really focus on being able to get those right 15%, and even out of that 15% you have to get it down to a really meaningful size at some point in time. So that, I think, that filtration process, that that thought process about how to really go about it, I think that has there's a lot more clarity in my mind now in terms of what to look for and so on and so forth. So and in my personal portfolio, I do both. Like I do give my money to some professional managers to manage, and I also do some direct investing as well. And the direct investing part of my portfolio, I have really benefited from that book. You mentioned the term emergency fund. I'm a big believer in emergency fund, and that fund always has to be in some kind of a fixed deposit or a liquid fund, something of that sort. So I have a certain portion of my money in that. I do have employee provident fund, PPF, NPS. So all of these are kind of debt instruments, if you like. So the FD plus, all of this debt instruments. I think those are fixed income products that you can be assured that, to an extent in the FD, of course, but you can be assured that they are protected, to that extent. And then the rest of it, I would say real estate, the way I think about real estate is I'd like to invest in that real estate that I can use for myself. I'm not thinking about it as an asset to kind of generate a return, but
Okay.
the only real estate that I have right now is the house that I live in, right? So that is how I kind of think about it. The rest of it all, okay, is an investments, okay, in equities, okay, and that can be in the form of some direct investments that I've made in the Indian market as well as abroad, in the US markets, especially for innovative companies. A fair bit of startups that I've invested in. I've given my money to professional money managers to also manage, right? So that's kind of the broad distribution, if you like. And if I were to kind of look at it, I would probably say about 70% is in the equity portfolio and 30% is in the real estate plus the debt portfolio. That's how I look at it. Is it balanced? Probably not, because there are a lot of things that I could rebalance over a period of time. So yes, I mean, sometimes your portfolio becomes lopsided because so for example, I'm carrying a lot of Accenture stocks at this point in time. One, because the requirements, and two, also because the stocks vest over a period of time, and if you end up selling, you have to end up paying a lot of capital gains. So you carry those stocks, right? So it can become lopsided over a period of time, but that's the nature of how you have to really manage.
Right, absolutely. One rapid fire question.
Sure.
Would you invest in stocks, or would you pay off your home loan first?
I would invest in stocks, because the home loan is at a very low interest rate compared to what I would have otherwise, and I also get benefits from the government, both in terms of repayment on capital and interest paid, right? So that way my net outgo on the home loan is much lower than the maybe 8% or 7% that you're paying on the home loan. The net would come to 4.5% to 5%, of course, depending on the quantum of your home loan, etc. And I do believe that if you do invest in good companies, or if you even invest in the Nifty index, it can give you much better average returns compared to what you're paying on your home loan. I will not borrow money to invest in the stock market. That is not how you should really think about it.
You have a very healthy attitude towards money, other than coffee and investing and psychology of money. We brought that book into our conversation as well. Other than these two books, any other couple of recommendations that you have in the personal wealth management, or in the finance or investment itself, in that genre?
Much earlier in my journey, I read this book called One Up on Wall Street by Peter Lynch. It's a very good book. Again, a very easy to read book, and full of practical examples, right? About how should you really think about investing, and so on and so forth. So very Peter Lynch was one of the most successful wealth managers. So very good book is what I would say. There's a book by Jim Rogers, okay, and it's a very good book because it combines two things. One is finance, and the second is travel on a bike, right? So Jim Rogers is actually going around the world, okay, and one is he's describing his whole travel through the entire world, but then he's also describing the opportunities in the market and what he sees in the market and whether he would consider investing in that market or not. Good reads, both of them. I would recommend.
Fascinating. Deepak, who would have thought that I will have fun in talking finance? So once again, thank you very much, Deepak. And to our listeners, thank you for staying back. See you in the next episode.